Hi, great to have you all. And we have on this panel very different segments of the VC and private ecosystem. So let me start by requesting each of you to probably introduce your funds and what the focus is. And then we can try to understand how we all come together.
Okay, good afternoon. My name is Vineet Rai. Represent Avishkar, which basically is an impact fund, but we invest in almost all sectors. So we are sector agnostic. We are on our 8th fund. We've been around for 25 years. So many investments that we have done. Everything from agriculture to technology, everything that is very basic to cutting edge, we do everything. So.
Hi everyone, my name's Anisha Singh. I run a venture fund called She Capital. It's very easy. Actually, before this, I used to run an internet company called Maidala, or sare puchte the wo hai kya. So I just figured it's easier to do and explain it with the name. Obviously, we invest behind diverse teams or women-led teams. We're now on our 2nd fund. We've also had the great fortune of investing with IvyCap on Clovia. So that's probably it.
Sam?
Hi, good afternoon. I head Bajaj FinServ Ventures. This is part of Bajaj FinServ, the financial services unit of the Bajaj Group that comprises of lending, insurance, asset management, home finance. So several businesses, and there is health and a platforms business, all of it in there. But we have a new alternatives business that has been launched in the last 2 years, and this is just 2 years old. It's a new business at Bajaj. I'm an old guy, but it's a new business at Bajaj. And our focus is to not stray completely far away from the corridor where we make our money, okay? So financial services, BFSI broadly, and various technologies and ecosystems and platforms, what have you, that have a linkage, adjacency to that. Having said that, we just put in money in a fresh groceries platform, which is a little bit away from it. So we are opportunistic. We will look at consumer deals, but largely it's B2B at the moment. That's what we do. It's growth equity, venture capital. It's a new business. I think we printed just 200 crores and we'll cross 400, 500 this year.
Imran Jaffer, I'm a managing partner with Gaja Capital. We've been in business for 20 years, so a shade less than Vineet. And we're investing out of Fund 4. We typically invest in the 10 to 100 journey, so companies that have crossed roughly $10 million in revenue, and we help them scale to 100 million. In over $1 billion that we've raised in the last 20 years, a fourth has gone into education, employment, and employability, so that's a core area of focus for us. 1/4 has gone into consumer, 1/4 into BFSI, and a fourth has gone into intelligent software and automation. And I'm very happy to be here because we recently invested in an IvyCap company called Egos. We're very excited about that. It's a superb company and great set of founders.
Sohail, he's joining us remotely. Sohail?
Yeah, thanks, Ashish. So I'm Sohail Chand. I set up and run Nueva Advisors. It's a relatively new early stage fund. We've made about 35 investments in India over the last 2 years or so. We invest in early stage businesses from seed to sort of Series A, and that's our focus. We are sector agnostic, but we want businesses that are scalable. We've invested with IvyCap in a couple of businesses in Biryani by Kilo, work closely with Ashish there, and we're doing a media business at the moment together.
Great. So I think we have, all of us are VCs or private investors, but there are so many nuances, right? For a founder sometimes who's not familiar with the lay of land, an impact investor, early stage, then a group kind of venture arm, late stage, and Sohail representing a family and sort of a VC fund. So help people understand what kind of founders come to you, why should they come to you, as opposed to any of the others on the panel. And of course, can go to everyone, but what is the sweet spot?
I think you will hear the same answers. So I think Imran and I probably we do similar space, 10 to 100 crore. That's what we look at. So if I'm an entrepreneur and I'm looking to raise capital, the first thing I'll try to see is what amount of capital and what stage that I am in. So Avishkar was known for actually investing in people who were actually at the idea or conception stage in sectors that have not even emerged. Over a period of time, as our size increased, we have actually graduated up. And then there is a huge amount of early stage ecosystem that has emerged as well. So now we are probably a Series A investor. Earlier we used to be pretty much a seed stage investor. And we do come quite late as well in case we find an opportunity. A lot of people ask us what is impact investing. I normally ask entrepreneurs, have you seen an entrepreneur who doesn't deliver impact? It's very difficult not to deliver impact. So the question then comes down is how does an impact investor look at it? We look at a deliberate strategy to incorporate impact and a desire to actually disclose or report on impact like you report on your investment behavior as well. So when you raise capital, you do talk about your performance. You look at that performance and try to integrate with your impact performance as well. So that's the second part of it. But more importantly, what I look for is if I meet somebody, how convinced they are about their business idea. And when they are convinced, are they bullheaded? If they are bullheaded, do they have the opportunity, or if countered with facts and logic, do they have the ability to reflect? So while I need people who are very convinced about what they are doing, we also try to make an assessment whether they can reflect during their journey on feedbacks coming from outside. As investors, we have learned the hard way that we do not know where the entrepreneur should go. So entrepreneurs should decide that. But we do know where entrepreneurs should not go. And so our role with the entrepreneurs is largely to tell them what not to do rather than telling them what to do. And we try to see if entrepreneurs have a desire to even listen that part. I have rarely come across an entrepreneur who will listen where to go. And if we find such an entrepreneur, that's a write-off in any case. So partly because all investors, I can tell you, we are mediocre guys. We are looking for brighter people to lead us. And so when we become the bright guys, chances of a write-off is very high. So that's basically the end of our story.
Anisha?
So I never considered myself an investor. I was always a founder, And I used to think VCs are scum of the earth, by the way. Because itne time VCs ko pitch mara tha, and how many rejections I got, I always believed this was the worst class or breed of humans, okay? When you sit on that side of the table, you actually believe that. Now that I sit on this side of the table, I happen to think differently. But otherwise, also you realize suddenly that it takes a large leap of faith to put your trust behind founders and actually let them lead it and just be on the sidelines. And those are the kind of investors we actually like investing with also, because really, as Vineet said, founders should lead it. Founders know what they're doing. You're just there as guardrails to kind of just guide them, and that's about it. And so we like investing with those investors broadly, and we've had the good fortune with our entire Fund 1 that we've invested with those kind of investors on the portfolio. That's broadly what we do. We come in at seed stage and pre-series A, but we like that you've got revenue. We don't do ideation stage at all. And I think the fact that I've been a founder in the ecosystem since 2009, Facebook pehle ads maine chalaye the India mein, that matters, and people seem to care about that, and founders like that. I understand their point of view.
So founder-friendly approach.
Yeah, founder-friendly सारे कहते हैं. So I don't like that word, founder-friendly. I think investors broadly are. If you take that much leap of faith to invest in founders, you are friendly. So, and I think founders realize that. It's just In general, it's a hands-off approach. Only when needed, we will step in, but we are guardrails there in case.
Sam, you all have started, I think, a new perspective from a group venture capital. So do you see yourself different from VCs and how they invest and tenures and risk levels, or you have your own strategic requirements to fit with certain kind? Can you explain how your group would look at a VC type investment?
It's a very interesting question because it is a little different than many other funds. For more than 20 years, I deployed capital as a regular investor, growth equity, venture capital, et cetera, et cetera. There are more than 350 transactions on that highway to difficulty, highways of difficulty that I've done. Having said that, this is different. If you look at these mega trends that are driving growth of basically every economy in the world, every large economy to be specific, it's not possible for public companies, large groups to participate in those mega trends to the same amplitude that a venture capital investment can. It's very difficult because they are in there, they have to deliver EPS quarter on quarter. They just can't fritter away their money into different ideas. Having said that, those are going to be the areas where future growth is going to come. For us, future lending is going to come. Future insurance is going to come. Future customers are going to come from. So it's very, very important for us to be in that, to cite that early. That is a main driver. So we focus on that. Number two, we have a large ecosystem of vendors. There are more than 200, at least 200 vendors, several of them tech and tech focused, that are helping our businesses. There are more than 105,000 employees, and there are more than 4,000 people who have tech backgrounds in the group. So collectively, there are multiple companies sitting inside our group itself, smaller ones, and there are a huge number of vendors in the ecosystem, and several of them have grown like this over the last couple decades, some of them last decade, some of them. So that is a target. That's an important opportunity for us. And once we got off the ground and once we started focusing on these areas, deals started coming in. We've been around open for less than 24 months, and we just have a large plate of deals because the market understands very quickly where we are. Market's actually much brighter than we are. The market understands where we can add value. The recent deal we did together, which is in the logistics software technology space, very interesting. There's a marine insurance angle. There's a trade finance angle. There are multiple angles in which our group can play a very active role helping these companies. So we are very interested in that as well. So we look at that in that way.
Great, I think that's quite clear. Imran, your, Gaja comes from, origins are in private equity, which is slightly late stage. And of course, now there is this, lot of PE funds are moving slightly earlier. So can you explain how the perspective is different from a pure VC and how you're finding your experience now with investing in companies which burn money, if you like, which is different from what the original idea was?
Yes, I think we've retained our private equity bias, but we've learned a lot from the VC ecosystem. I'd say from 2018 specifically. I mean, we started in 2005. It took us 13 years to catch up to the VC ecosystem, partly because the ecosystem itself was maturing. But certainly since 2018, we discovered that we can still retain the aperture of private equity, which is we're looking to find scale-ups, companies from the startup ecosystem that are now ready to scale up, meaning there are no questions on management continuity, product market fit, adjacencies, and there's a certain maturity of wrestling with a problem for a long period of time. And then we come in companies that are roughly 100 crores and help them to scale to 1,000 crores. So in many ways, our aperture has remained the same, but the VC ecosystem is now throwing up very interesting opportunities at the scale-up stage. But the learning for us has been, like you rightly said, Earlier, I remember we used to buy companies at 1.5, 2 times revenue. Everything was about, EPS growth. Everything other than EPS growth was a vanity metric. I mean, I remember the first decade, we wouldn't even talk to a company if you were making losses. And so we've had to learn, and we've had a good experience learning, that there are companies that are early in a cycle. And when you're early in a cycle, SaaS is a great example. We are in Lead Squared, we are in SignZ. You have to invest. And then you take a leap of faith that at some point operating leverage will kick in. But like Egos, for us, Egos was, I think what really excited us there was Abhishek and Aditya, the co-founders, they wrestled with that problem for a long time. And so starting from a poultry farm to forward integrating in many ways, so we drew comfort from the fact that they were long-term, they had a long-term vision, and the TAM is just massive. And so we took comfort from the fact that this is not just a startup, and it helped that they were profitable in one of the quarters that we were investing in.
Sohail, coming to you, you have a perspective from a family office as well as from an international VC fund. So again, can you share your perspective on how you look at a family office would look at it differently or an international VC would look at it differently?
Yeah, so I've actually, I mean, before I was a family office or an international VC, I actually worked at a growth sort of equity firm as well. So seen it from all these angles. Look, from an international VC perspective, or the way we are looking at it from a VC perspective is we want to. We think the risk return in the VC space is quite favorable in India, right? Early stage, there's a ton of opportunities here, ton of great businesses to be built. Um, so we are willing to take some risk, right? And that's part of the reason for going early and doing as many deals as we can, because we know a lot of them will explode, a lot of them will blow up, and that's fine with us, right? We do 35 investments in the expectation that maybe 5 will make it big. And that's our whole philosophy, and that's how we assess the risk return metrics on each deal. And I think that's consistent with what the great sort of international VC firms have done. If you look at Silicon Valley, or you look at some of the talks that some of the leading VCs, global VCs give, it's all about finding that outlier and finding the one guy who's going to return your whole fund. However, I think when you look at it from a family office lens, it's a little different. I think there it becomes more about not doing any harm, and people are willing to, I don't think the appetite, for one, I don't think they do the velocity of deals or the number of deals that a VC fund does. So maybe if you're a family office and you're doing 3 deals or 5 deals, you need to be a lot more certain that all of them are going to make money, or out of that 5, at least 4 will make money. So your risk return metrics become quite different. Secondly, I think family offices all say they want to do VC. They want to hit it out of the park, and everybody will have this one anecdotal example of, look, we put 1 crore or 10 crores or something, and we made 10x our money or 100x our money, as the case may be. But for the most part, I found that they tend to be, as I said, more risk averse, but they also have much shorter timelines, which is a little ironic given that they can hold things on their balance sheet forever. So we've seen a big migration towards later and later stage businesses from family offices, and also sort of pre-IPOs, and really trying to participate in that ecosystem.
Thanks. So I think for those listening, I think I often hear from founders saying, we went to this investor and he said, no, he didn't even look at it. So it's important to understand that all investors have a certain angle and way of looking at it. And when you are looking to pitch, you probably need to spend the time to understand where these investors are coming from. Otherwise, there'll always maybe you run the risk of misfit between capital and the business plan that you're pursuing. Right? Now let's go to...
But it's not even about that, right? I think as founders, we don't understand that it's also timing when you're talking to the investor and what the portfolio mix is looking like. If I've done 2 food tech deals, I'm just saying hypothetically, or health tech deals back to back, the odds of us re-upping maybe might not be on that, because the portfolio construct, you want it to look different, right? And so now that understanding, I think, comes better when you're sitting on this side of the table. And so I tell founders all the time, don't take it personally. Each no is not a personal slight on you, you know. So definitely go back and take feedback from the investor on what it was. Was it really your thesis, or was it just because everybody just says timing and says, come back to us, we want to follow up. Is it really that, or was it there was something wrong with the thesis?
No, that's exactly right, and that's, I think, very useful advice. I just want to confirm that from a timing perspective, how we are doing. Madhuri? Five minutes? Okay, fine. Let's go to the favorite question. You know, everyone on the audience wants to know, where are you guys thinking of making the most money now for the next 5 years? What are your favorite sectors and themes? Everyone wants to know that. So, and we got to make it valuable for their, you know, for them to come here. So, hopefully they'll go back rich.
I think as an investor, I won't do justice if I start telling where I'll be make money. Then I'll actually become a clairvoyant. Investors are not clairvoyant. We try to make judgments around. And remember, and I think a lot of people don't understand, it also actually depends on where a large percentage of the capital is going. So it doesn't matter where, what I think, it's actually the follow-on capital that becomes very critical. So you're talking to people who are coming in maybe Series A, maybe latest I'll come in Series C. I still have to see where the markets come, where the next round investor is coming from. And if I do not have the right follow-on, I may be very fanciful about a certain sector, but if the whole sector is, or other people are not excited about it, it's not going to generate value. So, and I have, because we were very early, I had those fancies. I went into waste sector way before anybody even thought about it. And I was the seed round, I was the Series A, Series B, Series C. Till Series C, I was the only guy investing in my own company and feeling proud of it. And of course, I didn't increase the valuation. So the entrepreneur got very angry. So first thing we need to understand is, and I would actually be the last guy to say it because I have done all kind of foolishness in the past. 25 years bring you down. It's very important for us to understand where the capital is going. And the capital actually is very moody. So it keeps identifying new areas to which excites itself. And it's also very cyclical. So the something which is out of favor might actually come and back into favor down the line. So I would always never hazard a guess. A great entrepreneur with great conviction in his or her idea is actually the right place to put your capital. Because they will find the right place. They will actually pivot and find the right mood, and they will do it. We are not that smart, so I'll not hazard my guesses on that.
Very interesting. I think you have successfully dodged your tips, but basically follow the founder. Select the founder.
I hate going after him.
Sorry?
I hate going after him. It's like
Go
somebody who gets 10 on 10, uske aage kya bolo tum? You know, you're stuck because how do you one up this? This is the perfect answer. Yeah, you just can +1 it and say, yes, I agree on this one.
But do you have any favorite themes and sectors at the moment?
I don't have any favorite themes and sectors because now I just have to +1 and say it's all about the founder. It's also on timing and luck, right? We did Clovia. I feel we came in and there was, unfortunately, bichare thoda ghis rahe the, and then suddenly just fate and destiny took over as well. So as a founder, that happens as well, right? It's all a perfect storm that makes it happen. So no, but that being said, I'm very bullish on one sector, which is sports. I think sports and sports tech is underserved. It is something that has to pick up. It will pick up. So travel and sports, I'm very, very excited about. That being said, like Vineet, it's like you have to follow the money and you have to see where it goes. Health tech is brilliant. I had one of my portcos, Rimjim was here earlier speaking as well. So, I mean, health, we all care about.
That's great. Sports and health and travel. That's good.
Founders in general.
Founder, of course. I'll come back to the founder question in terms of what we look for. Sam, what are your favorite themes and sectors?
So I've got to agree with a lot of what Vineet said. For sure. I won't put my finger on a single 1 or 2 or 3 sectors, definitely not AI alone. AI is AI is amazing. AI is going to lift a lot of things and take a lot of things to a lot of good places. That's true. Having said that, we are in the business of making money in 4 or 5 years, making multiples of invested capital and get someone else to buy off what we are investing in, which means they've got to see multiples at that time when they're buying from us. Simple math. The art of the exit, right? The art of the deal, important. But art of the exit, more important. And I always say, when we're looking at something in steel conversion, brute steel, crude industry, right? We're looking at something in technology layer that sits behind e-commerce, but it's specialty. So we're looking at areas where that thesis sits well, where we are able to multiply capital over a period of time, 4 or 5 years, and be able to find an exit. There's something in real estate. So there are pieces that exist where there's huge amount of inefficiency in basically every vertical, and we try to find some of those if we can.
Imran?
Our perspective is a little different. We live and breathe very few sectors, and we really go deep. So our coverage kind of is exhaustive. We try and know all the founders in the sector, all the CEOs, the CXOs, the consultants, advisors, etc. So the 4 sectors that I spoke at the beginning, which I won't repeat, are important. But let me also share the deals that we've actually done. So we invested in Fractal Analytics recently, which for us is a picks and shovels into the whole AI super cycle that we believe is upon us, and we're very excited about that investment. Roughly 1/3 of everything we've done in the last 20 years has been to partner with experienced protagonists and buy controlling stakes in companies. So we invested in an affordable housing finance company called Weaver Services. Manjari was here earlier. Manjari and Satrajit used to be colleagues. We backed Satrajit, put together a professional team, capitalized it with 170 million. Premji and Lightspeed joined that consortium. And we have a 2,000 crore AUM, which will scale to 20,000 crores. So that's the business building on the back of proven protagonists is the other strategy. And otherwise, our bread and butter business is the archetype of egos, for example, very large TAM, professionally qualified entrepreneurs, where we can play a role in the scale-up journey.
Sohail, your favorite sectors?
So I actually agree completely with what Vineet said. What he said really resonated with me because for us it is about the micro and about sort of really backing an entrepreneur with a specific vision. Having said that, I think AI is changing the world. It is the biggest thing to have come out in sort of a while. And we want every one of our companies and any company we look at to have some kind of AI angle. So that doesn't mean they need to be AI application companies. For example, Ashish, we are sort of going to work together on this sort of movie TV production business, and even their business is being disrupted by AI, right? The cost efficiencies you get, the way that you are producing content for OTTs is just being changed dramatically with AI. So there's that kind of angle in every business is changing the cost structures of traditional businesses. And I think some of that is very exciting because the amount of profit you can take out, the way you can change your whole cost structure is just very interesting.
Great. I think we have limited time, but I want to do a very quick round here because everyone says that we invest with the founder. I'm just going to pick a few traits and you tell me what kind of trait you would like to back, right? Fresh out of college or experienced or later stage founders?
Yeah, if serial entrepreneur best, but we do everything, fresh out of college to late stage. The roles changes in a fresh out of college will be way more proactive than in a serial entrepreneur.
What do you prefer?
There's no preference. Idea and conviction. We don't actually, I'm very clear, everything has to play out. So just because the entrepreneur is important, the idea is equally important, the kind of traction the entrepreneur is. And remember that I may be excited about the idea today. Will the idea be exciting 6 years down the line when I'm exiting? That is equally more important. So,
Anisha, tech heavy or product heavy founders versus much more commercial founders? Would you invest in PhDs?
Oh, I don't know. And you know, I gave him the idea of the quickfire round. Oh God. Um, Look, it's tricky. I'm just going to say, like Vineet, it depends on the founder. You know, I can't. It's about the idea. It's the founder. It's everything.
You don't have a bias.
I don't have a bias on anything. I really, you know, what I do have a bias on? Passion, grit, and integrity. Uske aage jo bhi hai is great. But you gotta have those three things in place. It doesn't matter to me. Tech founder, product founder, whichever founder you are, commercial founder, whatever that means. If you're in the business of just fundraising, then there's a problem for me. Other than that, we're good.
Okay, so founders who have been through an executive journey and then starting up, or entrepreneurs from the start?
So far, everything I've seen in the B2B space are founders who've been through some kind of a executive journey for some years. I don't see that. We don't really see so many founders straight out of college during B2B in India. But in Silicon Valley, I've seen that. In New York, I've seen that. But I don't see that in India. But I'd like to see that, and I'd like to back. Now, to your point, Vineet, I'm age agnostic, but definitely not investing in someone 65. No, nothing against anybody, because one has to have a 10-year runway. I'm getting to that age soon, right? So one has to have a 10-year runway. Without a 10-year runway, it's hard to see life in the blood vessels of the business after that.
Imran, family businesses versus professionally led businesses?
Professionally led, clearly. In fact, we have almost I can't think of any company except one out of 28 investments where the founder and the management team were not professionally qualified, experienced folks. Yeah.
Sohail, we know some funds look for mavericks, right? What is your bias? Do you like it realistic, or you like realistic founders with crazy ideas, or crazy founders with crazy ideas?
You know, to be an entrepreneur, you have to be a little bit crazy. I think that's you have to be incredibly optimistic. So I don't want people who are a little too realistic. That's my bias. I do want people who see the big picture and who have that vision, because that's the only way you can get out of bed and challenge yourself to sort of build these large businesses. You have to be a little crazy.
Okay, we've really run out of time. On that note, I think we'll stop here. Thank you very much to all of you for sharing your insights. It's been a